Most juniors are not investable, according to my guest, Matt Geiger, with MJG Capital, where he's managing partner, and we're here at the Palisade Hard Hats Conference in Jeckyll Island. Can you tell us about your findings looking at juniors, Matt?
Absolutely. Well, I just gave a talk at the conference, and the main emphasis here is you have to be extremely selective in the junior space. I'm a big believer in Pareto's law, that the top 20% of any population is going to result in 80% of the value. And if you take that a step further, the top 4% of any population is going to generate 64% of the value. So, in my opinion, you need to be rejecting the vast majority of juniors that are trying to get you as a shareholder and really focus on the very top 4 or 5%.
When you tinker with juniors, when you look at what's underneath the hood, look at the financials, what's usually, how are they going a scupper?
So the vast majority aren't investable. There's quite a few reasons for this. It could be debt on the balance sheet, it could be a blown out share structure. Most commonly, it's excessive amounts of G&A. Rick Rule's group at Sprott Global did a really interesting study. They looked at 75 companies with a sub $10 million market cap, and they found that over a 5-year period, over 60% of the money that these companies raised went into G&A. So that's director salaries, that's expensive travel, that's first-class meals. That is not what you want as an investor. You need that money to be going into the ground, either in terms of drilling or engineering work as you continue to advance your project towards feasibility. And so that right there is a huge reason why you should not be buying juniors as a basket. You've got to find hand-selected names where management is doing right by the shareholder and putting the money to work properly.
It's been a beaten up sector, obviously, and then also what is actually happening with China, and we're looking at the slowdown over there, but you still believe in the longer play role in the mining and the resource sector. Why? I
do, yeah. I mean, it's been a very tough period. As you're well aware, between 2011 and early 2016, we went through a devastating bull market. I'm of the opinion that we entered a bull market between 2016 and January of 2018. But since then, we've kind of gone back into the lows, and there's a lot of depressed investors out there. But to me, this is a cyclical industry, and you've got to buy when it's not attractive, and you've got to take profits when you see generalists streaming into the space. So I'm very optimistic about these upcoming years, but you have to show patience and pick the right stocks.
You've taken some unusual spins or unusual looks at the mining sector. You're one of the youngest, I hear, within your profession, and then also you're based out of the mining center of San Francisco as well, too. Can you tell us how you've actually gotten into this industry?
Absolutely. So I was born and raised in San Francisco. It's definitely off the beaten track in terms of your typical kind of resource locale. To me, there's not a very simple answer. I don't have any family leads into this industry. To me, just from a very young age, it's made a lot of intuitive sense. I'm a massive fan of anthropology and history, big reader of Jared Diamond. Collapse is one of my absolute favorite books. And to me, as long as we have a global population that's growing exponentially and consumption on a per person basis that's also growing exponentially, something's got to give, and I think it's going to happen in my lifetime. So that was one thing that initially attracted me to the space. A second is that, at least in the Bay Area, is viewed as an old-fashioned, stodgy industry that should honestly be looked down upon. That's the general viewpoint there. And I think that's incredibly hypocritical. All the cool technologies that are being developed in Silicon Valley require these metals to power them and to actually make them work. And so to me, the fact that people look down upon the industry kind of tickled my contrarian instincts and drew me that much more to the space. And then finally, there's really no more space, there's no space out there that's more volatile and more cyclical than the junior space. And most investors, when they see volatility and cyclicality, they stay away. They want nothing to do with it. But for me, I'm of the opinion that if you have you need to have the right relationship with volatility and cyclicality. Almost look at them as your friends, and try to think of it that way. And so, you know, that to me, and I do have kind of a stomach for it. You know, even when times get tough, we keep going. So it's kind of those three reasons which really drew me to the space originally, and I'm going to keep doing this as long as I can.
Thank you very much. I've been speaking with Matt Geiger. He is the managing partner at MJG Capital in San Francisco, and we're here at the Palisade Conference, the Hard Asset Conference on Jeckyll Island, Georgia.
Thanks, Mike.